We certainly think things are improving in emerging markets. We recognise that the last few years have had many negative headlines for the asset class. We've had concerns about China slowing down, we've had economic and political troubles in Brazil, and also we've had the first increase in US interest rates for over a decade. All that has been quite negative for emerging markets, and it's caused emerging markets to lag behind developed markets by 62% over the past 5 years. That's the biggest performance difference on record. The good news is that we think things are improving. We've seen that asset allocators have generally turned more cautious on the asset class from 2012, but more recently we've seen global asset allocation move to a more neutral position in emerging markets. The good news is that we still have the potential for investors to move overweight, and that could direct a lot of flows into emerging equities and help performance. Generally, this is good news for emerging equity prices. We've seen historically that emerging equity prices have a positive correlation with oil and commodity prices. We actually think that the oil price is set to stabilise or even improve from current levels. We've seen quite a big drop in investment in the energy sector from 2014, and that's reducing some of the excess supply in the industry. We also think that a slightly weaker US dollar will help the outlook for the oil price moving forward as well. In terms of commodities, importantly, we're seeing a number of production cuts for commodities. For example, aluminium, 10% cut in production this year. And for commodities that are oversupplied, we're seeing some consolidation, for example, in the Chinese steel sector. So the outlook for commodities and oil prices are improving, and this is very important for emerging markets because the last few years, these two sectors have caused the earnings growth in the emerging market to be low and be disappointing. Now we see that turning around and providing a positive boost for the earnings growth and therefore the outlook for emerging markets. Yeah, the valuation profile for emerging equities we think is very attractive. Most countries and sectors in emerging markets are trading at valuations below their long-term averages. When you take the emerging markets together, they are trading at about a 33% discount to developed markets. And we think that discount has gone too far and will close up towards the historic average. These low valuations and our positive outlook for emerging market fundamentals means that when we look at emerging equities compared to other asset classes, we expect returns over the next 5 years of at least 10% per year from emerging equities. And that ranks emerging equities at the top of our expected returns for all asset classes. We think that the potential of emerging markets is still underestimated by investors. So for example, emerging markets are home to 90% of the population aged under 30. 47% of global GDP is coming from emerging markets. That's set to go to 57% by 2025. Yet for all this scale and potential, emerging markets only represent about 11% in world stock markets. And we think as these two sectors come together and normalise, that can provide a lot of attractive returns for investors in emerging markets.